Erin, let me turn to you and pick up on where we were talking just now with Chris about where you hide if you're really an asset allocator. You said cash is one alternative. Are there things, though, that involve at least some risk that you go to? And how much of it depends on what you think the recovery is going to look like whenever it comes?
So I'm going to flip that sort of question and answer the second question first, which is, unlike prior recessions that we've seen in very recent history, so think of the global financial crisis or even the pandemic of 2020, I don't think this is going to be a V-shaped recovery. I think this is going to be more of a prolonged, sort of stalling of the economy and more of an L-shaped recovery than what we've seen in the past. And the reason for that is because inflation is high and is likely to persist at high levels, you're not going to come in and see the Fed start cutting as the unemployment rises, like we've seen in the past. Instead, because the Fed has, moved from a dual mandate Fed to a single mandate Fed, really just focus on getting the inflation rate down, you'll likely see, you won't see this sort of immediate relief that we've seen in recent history. And so that does change a little bit the landscape of how you think about investing. Historically, as we start to get closer to what we expect the bottom level of the S&P 500 to be, we start to, scale risk back up, start to move back into equity investments to catch that recovery to the upside. And this time around, I think you have to be a little bit more patient. So instead, what we're really looking at is fixed income investments that we think are going to be able to sort of stand at the test of time, be able to sort of hide out in as safe haven assets. So beyond just looking at cash, we're looking at high quality investment grade corporates. We're looking at municipalities, municipal bonds, particularly for those who can take advantage of the tax advantages. Tax advantaged bonds, we think offer good value there at a sort of after-tax yield of 6.5%. In addition, we also like some mortgage agency bonds and structured credit bonds as well. And then sort of high quality equities that are defensive equities, high free cash flow, dividend growth, strong balance sheets. We also think do well in this environment. But, it is a sort of challenging time for investors where you have to skew more towards fixed income in order to have stability of return, as opposed to looking for a quick snapback in equities. But, I'd pose the question to Chris because I know he also manages a diversified portfolio. Chris, where are you looking at? What type of sort of diversification are you looking at in order to sort of hide out over the next couple of quarters?
Well, Erin, I've got the benefit of being able to go into private securities. So I've got a good sized real estate portfolio. We have a large private equity portfolio. Sure, it's going to have write-downs, but its value is a bit more stable than we see in the public markets. We have a cash position, but the problem is for us, cash is not outperforming inflation. So the old adage, cash is trash, is still true. We do like private credit. You were kind of hitting on that, variable rate debt, short-term debt with high quality. And I think collateral is going to be key because, as you said, we're going to have a long, rough winter. So you don't want to be loaning money to everybody. You have to care about governance. But it is tough in this environment. I mean, if the economy is slowing and inflation is still strong, that's stagflation. And you look back in the 70s, I got to say, I love that suit that Lou had. I don't know where you get that back in the 70s, but I'm stunned by it. But you look back in that time period, returns in 77 were terrible. They were hard places it was just a very tough time to hide anywhere.
Yeah, so I'm curious, though, exactly about when you go into fixed income. Do you think the price is attractive now in some fixed income, Chris?
Well, I agree with Erin. I'm going to go short. I'm not going to go long fixed income and take duration exposure. Short-term credits, I mean, you can hold a credit for 2 to 3 years, and then it's money good. And as she said, you're going to put it in a spread product, so you pick up a couple of basis points. By being in a corporate, you're okay. There's still a lot of money, David, international money that wants to come into this market, non-U.S. rather, that wants to come into the market. You saw it this week where it suddenly comes rushing in. So I would give the advice to the average investors, you've got to slowly average cost in. You're not going to be able to call the bottom. As much as Erin and I think there's a support number, it may not hit that at all. And the market's going to just bounce along. And in Erin's example of an L goes on forever. It's just flat. I hope we don't have to live in a flat recession for years and years, but I think this is going to be a tough market to find any kind of growth opportunities. So you want a protection and a return of your money rather than a return on your money.
Erin, one other big development this week was OPEC Plus and what they did. It certainly seemed to stun the White House at the time. What does that tell us about geopolitical risk generally, and specifically energy? It looks like oil prices are going to stay up there for a while.
I think that's one of the things that the market's really mispricing. Right now, if you look at the forward curve for oil, the risk is really in the sort of very short term, where the market expects that oil is going to be elevated for the short term, but it really hasn't extrapolated or extended that expectation out the next 1 to 2 years. And I think that there's real value in sort of the back end of the curve for oil, because I think that these oil challenges are going to persist much longer than what the market's anticipating. One of the reasons for that is, first we saw out of OPEC Plus this week, their intention to keep prices elevated. But I think the other challenge is that we really haven't invested here in the U.S. or on a global basis on energy infrastructure. So that capacity is really constrained over the next couple of years. Even if we wanted to expand capacity, or if oil producers wanted to expand capacity, they don't have the ability to do so in the immediate term. And that's going to keep oil prices elevated. So the risk for oil, then the risk for the energy complex broadly, isn't just this winter, but it's next winter as well. And next winter's challenges are going to be even more difficult, particularly on the shores of Europe, than what we're experiencing this winter. And so that's what I think the challenge is, and why I think this is something that's going to persist much longer than what the market's currently priced in.
And David, it's running into the challenge of climate change. I'm looking at decades, not a short-term trade in carbon. And I'm glad that we're having a constraint on the ability to expand hydrocarbons and burning carbon. But you're right, people want heat, and Europe heats itself, whether we like it or not. It doesn't heat itself with solar and wind. It's got to do it through fossil fuels. And that's matching and running into a desire to reduce the use of fossil fuels. And I agree with Erin. I'm hearing the same thing, that Europe has enough oil and natural gas for this year in their supplies. But if it's a really cold winter, they're very worried about next year. So you're going to have climate change crashing into this challenge of OPEC and inflation and energy prices, certainly over the next couple of years.
Europe has a lot of challenges, Erin, right now, not just energy, it goes beyond that. Does that make the U.S. relatively the most attractive place to be for you?
I don't know if it's the most attractive place, but it's one of the more attractive places, particularly vis-a-vis Europe. And the challenge that Europe has is that they're, starting from a lower productivity, a lower and weaker growth rate to start out. They also didn't, sort of fully recover in the same way that the U.S. did post-COVID. And they now have wider fiscal deficits. They're going to have to spend more money in order to insulate their economy from a harder hit because of energy. And that's going to create real challenges at the same time where the economy is rapidly slowing. And so our view is that while the U.S. is going into recession, the recession in Europe is going to hit harder and is likely to be more prolonged.